Oh boy, we are pricing in almost perfection, and that could be setting us up for some serious disaster over the next few weeks, especially over the next 2 days, because tomorrow is the CPI release, the Consumer Price Index Inflation Report release. We will talk about the actual expectations for CPI. Then we're also going to talk about the Federal Reserve expectations for the Fed, and I'll tell you, both of the expectations this time are really on the sort of bullish side, which I actually prefer when expectations are leaning bearish. When expectations are leaning bearish, it's really easy to beat them. For example, last month, we had expectations that inflation would come in at 8.1%, and that month over month would be at 0.6%. And I'm like, I don't know, man, seems a little high, based on some of the research and reading I was doing. We ended up coming in at 7.7 and 0.4, right along my expectations. I felt really good about that. Now, that's awesome. But those numbers were also leaning and starting high. The problem, in my opinion, is when markets are expecting bullishness, it's really, and good numbers, it's really easy to miss to the high side, and it's not so great. I'm going to end this video start by talking about those expectations regarding to the Federal Reserve. Remember how the Fed is regularly telling us that, we're going to hike rates and then we're going to stay high for longer. Well, there's actually to this. Let me show you some of the history, and then you're going to kind of see what expectations are, and you'll see what I'm saying here, okay? All right, look. For some time, all right, so that's the phrase we keep hearing here. What is the average time between the peak Federal Reserve rate and their first cut? Okay, well, the average is actually about 11 months. You can see here different peak and cut cycles. Peak rate, and then they cut until what rate, right? And really what we care about is this time. How long is for some time? Well, previously it's been 5 months, 18 months, 8 months, 15 months, and 7. The average here is about 11. So usually we stay at a peak rate for about 11 months. However, one of the issues with this chart here is that in all of these periods, inflation was relatively stable. If you look at these years here on the left, none of these years are like, oh my gosh, inflation was raging during that time. And if you go look at the early 1980s, and you're like, well, that was the last time we had raging out of control inflation, right? Or we could look at the Korean War back in 1951, where inflation plummeted within a year. But the problem with that is it was only war-driven rather than pandemic and war-driven, right? It was also before the time of really massive intervention by the Federal Reserve. So 1951, maybe not the best example. The 1980s were really weird because the Fed was really weird in the 1980s, and that's why they're not in this chart. They kind of raised rates, cut rates, raised rates, cut rates, raised rates, cut rates. Like when you look at the chart, it's just like, like they were so confused. And that's actually what the Fed is trying to prevent this time around. They're trying to prevent signaling confusion. And so that's why the 80s aren't actually on this chart. We're just looking at really years since then. And so since then, it's sort of like, okay, well, that's not great. It seems like they stayed peak for a while. Now, look, every cycle is different. In 95 and 97, we didn't, and really 18 rather, we didn't really in these cycles here face a potential substantial recession. We did face a potential massive recession and actually did end up having recessions here in .com and 2006. But still, if you just average this right here, holding rates high for longer, it's still going to put you at, what is that? That's 23 divided by 2. That still puts you at holding rates at a high level for somewhere around 11 and a half-ish months. That's a long time. We don't want to stay there long. Not only do we not want to stay there long, but it's not what the market is actually anticipating. Remember, the Federal Reserve meets starting tomorrow. Their meeting ends on the 14th, which is Wednesday. They'll raise rates, what's expected now, 50 basis points. And we're going to be looking for clues for the Fed's peak and then cut cycle. The problem is the Fed is basically telling us, hey, look, we're going to raise rates to probably 5.25%, and then we're going to stay there longer. Well, if they raise rates to 5.25%, that's not even as high as the market is anticipating. So if they raise rates to 5.25%, they'd be raising up to about this red line here. And if they held rates for about that average of 11 months, which whether you used all of the months that I just showed you or just the 2 previous examples, the average hold period is about 11 months. That would keep our hold period to somewhere around, let's see, that's March. about Feb of next year, so about right here. This is actually what the hike period would look like. But it's not what the market is pricing in. The market is actually pricing in that we don't even get to the peak of 5.25. We only get to about 4.75 to 5, somewhere in between there. And then we actually start cutting as soon as the summer, around June and July. And then we kind of just reduce from there. The problem with this is actually very bad. That, in my opinion, is very bullish. Okay, this is very, very hopium, very hopeful. But if the Fed actually stays with their 11-month hold on average, or honestly, even if they just hold anything more than 3 months, we're going to have to price in all of this pain. All of this orange right here needs to get priced in. The difference between their hold and where the charts are expecting right now. And this is why when you look historically, it looks a little remarkable that the current market is pricing in 200 basis points of cuts. And if you look in prior cycles, this is much more. What we're pricing in over here is much more than what we've really priced in previous to cuts in any cycle here previously, going back the last 30 years. Now, that's weird. I think one of the reasons the market is acting like this is because when we look at how deep the yield curve inversion is, the market is actually pricing in 500 basis points of cuts because we are so heavily inverted at about 80 basis points inverted. We are expecting about 500 basis points of cuts eventually. And sure, I actually do think that's going to happen, but the market is trying to say, oh, cuts are going to start in 2023. What if they don't actually start until 24 or 25? How deep is that recession going to go? Now, Jerome Powell did start going a little bit bullish in this last cycle, but all of that could die if the CPI expectations miss. And this is where we have a little bit of an issue yet again. See, CPI expectations last time were high. CPI expectations last time were easy to beat. Year over year was expected to be 8.1%. Month over month was expected to be 0.6%. And we ended up coming in at 7.7 and 0.4. It was really easy to beat those numbers. The numbers are a little bit different this time. Month over month expectations are 0.3 for both core and regular headline month over month. And the expectations for year over year are 7.3. You can see that here, 7.3 with a bias to actually it's pretty evenly distributed here, bias to the left and right, but still 7.3. And then a bias to the low side here, expectation 0.3, bias to 0.2. That's not great because we're really now in this December cycle pricing in that CPI tomorrow is probably going to be soft. I think the best thing we could hope for tomorrow is we just hit those expectations. Hit the freaking expectations. We don't even have to come in lower than that. And look, I know all eyes are going to be on the Fed. I know people are worried about wage price inflation, service price inflation, with the PPI coming in a little bit hotter than hoped here last week. But look, everything starts with the consumer. Consumer good prices slow down, then producer prices slow down, then wage prices slow down. We know rental inflation is coming down. We know the Fed's paying attention to this. We need this CPI report to come in low. This is the start of everything, or low or at expectations. That's what we need for tomorrow. If we just get at expectations, my belief is there's a reasonable expectation that markets can rally. Now, let me be very clear. I do not think we are at all for 2023 expecting a V-shaped recovery. This is not a Larry Kudlow, oh, it crashed, we're going to V-shape up. I think what we're seeing, or going to see next year, is we've got the V down. We've had a very, very quick V down. We've fallen about 3 times as fast as we did in the .com era crash. But I do think we're going to have a very kind of slow, gradual anchor dragging along the bottom of the ocean, slowly getting reeled up market recovery. And that's because our hopium is very high right now based on what the market is pricing in for a Fed U-turn. And any bad CPI report is going to derail that, especially since we've had this reputation of basically CPI comes in high, then low, then high, then low, then high, then low. We just needed to go low like last month and then sustained low. If we get that, rally mode. And then maybe that sort of soft landing that you just saw depicted there actually could be a reality. But look, there's no way to sugarcoat this. If tomorrow's CPI misses these expectations, like again, all we have to do is meet. We don't even have to beat to the low side. But if we miss to the bad side, it's going to be dirty. I'll be covering it live, so I can't wait to see you then. But buckle up. Buckle up. Probably the best actual positioning is just cash on the side. Because when the market opens, what's it going to rally? Like 3 or 4% before you actually get in? But if it goes to the dark side, it could just be so ugly. So, I mean, I think really cash is not trash. I think cash is probably the best asset these days. If you're in, you must have a very, very long-term mindset. And that's okay. There are a lot of people, myself included, that have a very long-term mindset. It's like, whatever. I'm just going to keep buying, pricing power stocks and build my quantity. But that takes diamond balls. If you have any short-term needs in this market, cash. You can always get in once we actually sustain good data points. Anyway, thanks for watching. We'll see you in the next one. Good luck, everyone. I'm going to the New York Stock Exchange now.